Hi there. I hope you're doing well. The purpose of this module is to examine the key roles that insurers play in the financial services sector. We will also review a few statistical concepts. Now, I'll say that I've drawn the information in this module from various articles and books on insurance, including the pages from the textbook by Professor Denis Boivin that are optional reading in this module. As for the statistical concepts that we will cover, I have confirmed them with a chartered actuary. Now we're going to examine the essential roles of insurers from two perspectives. First, the two private roles of insurance. And second, the three public roles of insurance. Now let's turn to the two private roles of insurance. Now, as we discussed in Module 1, the role of insurance is to protect the insured person, or in the case of life insurance, the beneficiary, through the payment of an agreed upon sum upon the occurrence of an event of an uncertain nature. Again, the role of insurance is to protect the insured person, or in the case of life insurance, the beneficiary, through the payment of an agreed upon sum upon the occurrence of an event of an uncertain nature. In the private context, this financial protection plays two roles. First, the protection of our assets. And second, in the case of life insurance, the protection of our successors and or our estate. Let's examine these two roles more closely. Insurance protects people's and businesses' assets by compensating them for destroyed, damaged, or lost property, or by paying money they owe to a creditor under circumstances specified in the insurance contract. Again, insurance protects people's and businesses' assets by compensating them for destroyed, damaged, or lost property, or by paying money they owe to a creditor under circumstance specified in the insurance contract. As a general rule, and subject to the terms and conditions of the insurance contract, insureds are entitled to be compensated for the value of their actual losses, no more, no less. This is what is called the principle of indemnity. So basically, the purpose of indemnity or indemnity insurance is to put the person back in a financial position as if the event in question had not occurred. So let's illustrate with an example. If a torrential rainfall causes the basement of your home to be flooded, and the damage caused to your property costs $75,000 to repair, well, the indemnity would take form of a $75,000 payment. In other words, a $75,000 payment would put you back in the financial position you would be but for the damage to the basement caused by the flooding. Indemnity insurance is the expertise of one of the two major categories of insurers that we discussed previously. And that category is the category of P&C insurers, or property and casualty insurers, in terms of the unabridged name. Insurance also is designed to protect the financial interest of our successors and our estate when we pass away. This is the case with life insurance. Since the life of a person cannot be assigned a monetary value, Life insurance is not governed by the indemnity principle. Instead, the insurance contract provides for the payment of one or more specified amounts to a beneficiary upon the death of the insured. For example, Pauline purchases a life insurance policy that provides for a payment of $100,000 to their daughter Alice. Upon Pauline's death, Alice generally only has to prove this fact to the insurer in order for Alice to be entitled to the $100,000. As we discussed previously, life insurance is specific to the second of the two major categories of insurers, which are life insurers. Now that we have examined the two key private roles of insurance, let's turn to the public or societal roles of insurance. In his book, Insurance Law, Professor Boivin discusses three key public or societal roles of insurance. First, risk distribution among groups of people or businesses. Second, compensation for damages arising from the fault of others. And third, economic efficiency. Let's look at these three key roles, starting with risk distribution. And as you will see, explaining risk distribution will reveal at the same time how insurance works. Now, I want to start talking about risk distribution by quoting a sentence from page 43 of Professor Boivin's textbook. And I quote, "Insurance is a legal device that distributes or channels the risks faced by one individual or a group of individuals who face similar risks due to the physical or circumstantial features that they have in common." Note that Professor Boivin is referring to risks that are similar because of common features. Now let's dig deeper into these concepts to better understand risk distribution. For risks to be distributed properly, and therefore for insurance to work properly, the risks insured must be homogeneous, dispersed, and divided. What do these three concepts mean? Well, let's examine them. First, homogeneous. A large number of risks of the same nature must be brought together which have a similar chance of occurring. Without the homogeny of risks, the statistical calculations that are essential to insurance become impossible. A single insurer may insure automobiles against theft and houses against fire, but the frequency of house fires does not help in calculating the probability of automobile theft and vice versa. This is because the risks of house fires and the risks of auto theft are not similar. To be able to predict the likelihood and extent of future losses based on historical data, in other words, to be able to drive with a rearview mirror, the data must have lots of similarities among them, and so that the future losses are statistically become able to be predicted. Second, the risks must be dispersed. What does that mean? Well, too many risks that are likely to occur at the same time or in the same place are generally incompatible with insurance. So to illustrate, and this is a hypothetical example, But imagine an insurer that had decided that its business model would be solely focused on insuring homes and businesses in Fort McMurray, Alberta, against fire. And that insurer had insured nothing else anywhere else. So again, imagine an insurer that had decided that its business model would be focused solely on insuring homes and businesses in Fort McMurray, Alberta against fire, and had insured nothing else anywhere else. That insurer would have known catastrophic consequences in the spring of 2016 when major forest fire consumed much of Fort McMurray. So that illustrates the importance of risks being geographically dispersed. Third, the risks must be divided. In other words, there must be a large enough pool of insured risks so that the realization of one loss does not sink the insurer. Again, hypothetical example. Take an insurer that decides that its entire insurance portfolio comprises coverage of only 2 homes. One home in Moncton, New Brunswick, and the other home in Vancouver, British Columbia. In other words, the insurer insures nothing else but these 2 homes. Although these risks are homogeneous and geographically dispersed, they are not sufficiently divided. The payout for the house fire in Vancouver would sink the insurer. In other words, the pool of insured risks has to be large enough so that the realization of one loss can be absorbed by the insurer. When the insured risks are homogeneous, dispersed, and divided, there then can be a strong correlation between the value of anticipated claims and the price of the premium that policyholders are asked to pay. Again, when the risks insured are homogeneous, dispersed, and divided, there can be a strong correlation between the value of the anticipated claims and the price of the premium that policyholders are asked to pay. This is called the principle of mutuality. Mutuality means a good distribution of risk among all policyholders and a good distribution of the cost of protection among all of these policyholders. So effectively, the basic mechanism of insurance is that by bringing together homogeneous, dispersed, and divided risks, which are, of course, uncertain when considered in isolation, but more predictable when considered as a large group. And we'll get to the concept of large numbers in a second. So effectively, by bringing together homogeneous, dispersed, and divided risks that are uncertain when considered in isolation, but become more predictable when considered as part of a large group, it then becomes possible to protect each person or business who is part of the group. In practice, though, mutuality is a goal that is not always easy to achieve, and sometimes even it's not possible to be achieved. For example, risks may not be sufficiently divided for mutuality when an insurer insures huge oil refineries or nuclear power plants. In both of these cases, the value of the claim can be in the billions of dollars. So, given the limits of mutuality, this is why insurers have invented techniques to address the limits of mutuality and techniques effectively for the sharing of risks with other insurers. Let's look at 2 of these techniques: subscription arrangements and reinsurance arrangements. A subscription arrangement is the sharing of an insurance risk among two or more insureds who are parties to the insurance contract along with the policyholder. Again, a subscription arrangement comprises the sharing of insurance risk among two or more insurers who are parties to the insurance contract along with the policyholder. In other words, such insurance contracts have three or more parties to them. The policy or insurance contract includes two or more insurers, and the terms and conditions of the policy generally provide for the proportion of the risk that each insurer agrees to insure. For example, an insurance contract may provide that insurer A insures 50% of said risk, insurer B insures 30% of said risk, and insurer C insures 20% of said risk. For your information, insurers in the Lloyd's insurance market, and Lloyd's insurance market is a market that's recognized as experts in insuring unique or highly specialized risks. Well, those insurers in the Lloyd's market often turn to subscription agreements, as demonstrated by the case law involving this market. Now let's move on to another risk-sharing technique, reinsurance. Unlike subscription arrangements, reinsurance arrangements usually take place without the knowledge of the insured. This is because the reinsurance contract is a separate contract from the insurance contract, and the policyholder is not a party to it. As the name implies, reinsurance means to insure again. In fact, reinsurance is the insurance of insurance. A reinsurance contract is a contract whereby one insurance company, called a reinsurer, insures, in return for a premium, another insurance company, which is called a cedent, against the risk that the cedent has assumed under policies or insurance contract that it has issued. So subscriptions and reinsurance are techniques for sharing risks among multiple insurers. And these techniques are in response to the fact that the principle of mutuality, although desired as an objective, is not always achieved and sometimes just cannot be achieved at all. Now, before turning to the second public rule of insurance, I'd like to clarify the principle of mutuality. As we have discussed, the purpose of mutuality is good distribution of risk and a good distribution of the cost of insurance protection among policyholders. Statistics are indispensable for the calculation of premiums and good distribution of risks. In fact, the probability of an event, such as a house fire in Canada, can be quite accurately calculated when turning to a very large number of actual house fires over a long period of time. This technique allows insurers to predict the probability of an event occurring with enough certainty to draw quantifiable conclusions. So, for example, if you flip a coin twice, or even 10 times, there's a fairly high probability that you will not get a 50-50 split between heads and tails. But the more you flip a coin, the closer you will get to a 50-50 split. Flip the coin 10,000 times, and the split will be very close to 50-50. Flip it 100,000 times, and the split will be even closer to 50-50. And this is called the law of large numbers. And it's really the law of large numbers that makes insurance possible. So this ends our discussion of risk distribution as the first of 3 public roles of insurance. Now let's turn to the second public role, which is the compensation for damages arising from the wrongs of others. In the context of indemnity insurance, it is not only the policyholder who can be protected by insurance. Insurance can also protect a third party by indemnifying the third party in the case where the policyholder was negligent toward the third party. This protection, known as liability insurance, is provided by P&C insurers. As Professor Boivin points out on page 44 of his textbook, liability insurance serves both as a shield and a sword. And I quote, "It is common to describe liability insurance as a shield, something that protects insureds in the event of their personal liability. But it is also a sword, something that gives everyone access to a reliable compensation fund." End quote. Examples of liability insurance include automobile liability insurance required to drive a vehicle, and professional liability insurance for lawyers, doctors, dentists, accountants, to name a few. Again, liability insurance protects 2 groups. First, the insured from pecuniary loss due to their negligence, and second, the persons who are victims of the insured's wrongdoing. This concludes our discussion of compensation for damages arising from the fault of others. Now let's turn to the third of the public roles of insurance, which is economic efficiency. Former British Prime Minister Winston Churchill had this to say about the importance of insurance, and I quote, "If I had my way, I would write the word insure over every door and upon the blind pad of every public man, because I am convinced that, for sacrifices that are conceivably small, families can secure themselves against catastrophes which otherwise would smash them forever." End quote. Churchill's words allude to the third public role, which is economic efficiency. So insurance is an effective and relatively inexpensive way, from a cost-benefit perspective, to manage and limit many financial risks. For example, for a premium of about $1,000 per year, a careful 40-year-old driver can insure their modest car and their liability behind the wheel for up to $2 million. This is because of the principle of mutuality and the techniques of sharing or dividing risks among insurers, such as reinsurance. So imagine the very unfortunate event where a driver, through their negligence, severely injures another driver, and the injured driver's damages are quantified at $1 million. Well, without proper insurance, both the at-fault driver and the injured driver would suffer enormous financial hardship if the at-fault driver's net worth was, for example, $200,000. But for a relatively small annual premium, these financial difficulties can be avoided. So this is the end of our discussion of economic efficiency. And so let's turn to a summary of what we discussed. So to summarize, insurance plays at least 5 key roles in the economy. Insurance plays the private role of protecting people's and businesses' assets. Insurance plays the private role of protecting the financial interests of successions and estates. Thirdly, insurance plays the public or societal role of distributing risks among groups of people or businesses. Fourth, insurance plays the public or societal role of compensation for damages arising from the fault of others. 5. Insurance plays the public role of efficiency. It is because of these 5 very important roles that insurers and many of their products are so highly regulated. We will discuss the role of this regulation over both insurers and their products in subsequent modules. Well, this concludes our podcast. Until next time.